Hey everyone, welcome to my office for today's explainer. I'm going to be acting as your personal loan advisor today to completely demystify mortgage mathematics and help you build your wealth. Whether you're looking to buy your first place or step up to that dream home, the numbers can feel a bit daunting, but honestly, they don't have to be. We're going to break down the exact math the banks use so you can walk into the housing market feeling totally confident. So let's look at your numbers and tackle the literal million-dollar question, well, maybe $500,000 question, on every homebuyer's mind right now. How much house can you actually afford? It sounds like a simple question, but the answer is a dynamic calculation. It changes based on your income, your debt, and, crucially, the broader economy. We're not just going to guess today, folks. We are going to calculate.
Here is our masterclass syllabus for today. We'll be covering calculating affordability, the 11% buying power trap, long-term costs, actionable strategies to beat higher rates, and we'll finish up with a quick affordability review quiz.
All right, Section 1, calculating your housing affordability. Let's figure out exactly what the bank thinks you can comfortably swing. When you sit down with a lender, they rely heavily on two major ratios based on your gross monthly income. First is the front-end ratio, which is strictly your housing costs. That's your principal, interest, taxes, and insurance, often called PITI. Then there's the back-end ratio. This takes that housing payment and tacks on all your other recurring monthly debts, things like student loans and credit card minimums. The absolute golden rule here: you should generally aim to keep your total mortgage payment below 30% of your gross income. Sure, some loan programs out there might let your total back-end debt stretch up to 43 or even 45%. But keeping your specific housing costs under that 30% mark is exactly how you avoid becoming house poor. It gives you the financial flexibility to actually enjoy your life outside of just paying your mortgage. Moving right along to Section 2, the 11% buying power trap. Let's see how a tiny interest rate change drastically alters what you can buy. You've got to see the 110 rule in action here. Basically, a 1% rate increase slices an $1,800 monthly budget's purchasing power by roughly 11%. That drops your max home price from $445,000 down to $395,000. Let that sink in for a second. For the exact same monthly payment of $1,800, a single percentage point hike literally strips $50,000 away from your budget. That's usually the difference between a newly renovated home and a total fixer-upper. Which brings us to Section 3, long-term costs and equity. Because rates change a lot more than just your purchase price, they fundamentally impact your wealth. Look at this comparison on a $144,000 loan. If your rate bumps from 5.5 to 6.25%, it adds just $69 to your monthly payment. Doesn't sound too bad, right? But wait, over a 30-year loan, that tiny bump costs you nearly $25,000 extra in total interest. That's $25,000 of your hard-earned money going straight to the bank instead of staying in your pocket. And here's the kicker for year one. At that higher 6.25% rate, you are actually building less equity. Even though you're paying more every single month, your loan balance ends up roughly $250 higher at the end of the year. It's the brutal inverse math of interest rates. When the rate is higher, way more of your cash gets eaten by interest right out of the gate. Okay, Section 4, strategies to beat higher rates. With rates hovering where they are, you are not powerless. Let's go over how to fight back. Your absolute best defense against high rates is your credit score. Maintaining a high score, especially up in that 740 to 780 range, unlocks the lowest possible rates lenders have to offer. If you're sitting at a 650, you're going to get hit with significantly higher rates. So before you even apply, pay down existing debts, don't open any new cards, and push that score up. It is literally the most controllable factor in your affordability equation. Another awesome strategy right now is looking into builder buydowns. If you're open to new construction, developers are highly motivated to move inventory. They'll sometimes offer a temporary buydown, paying a portion of your interest upfront to drop your rate by 1% or 2% for the first couple of years. It provides massive relief for your budget while you're getting settled in. Also, if you're a first-time buyer, definitely compare government-backed FHA, VA, and USDA loans against conventional ones. They often come with lower rates and are way more forgiving with higher debt-to-income ratios. An FHA loan, for instance, might let you stretch that back-end ratio further, and VA or USDA loans, they often require zero down payment if you qualify. And lastly, if your plan is to buy now and refinance later when rates drop, Always perform a break-even analysis. Refinancing isn't free. You've got 2 to 6% in closing costs to cover. You need to calculate exactly how many months it'll take for your new, lower payment to actually pay off those upfront costs. If you end up moving before hitting that break-even point, you're actually losing money. All right, we've made it to Section 5, the Affordability Review Quiz. Let's see what's stuck from today's masterclass. Question 1. What is the golden rule that recommended maximum percentage of your gross income that you should allocate for a front-end mortgage payment? If you said a 30% or lower, you nailed it. Keeping your housing costs below this threshold is exactly how you protect your long-term financial flexibility. Okay, question 2. According to the 110 rule we just talked about, a 1% rate increase reduces your total buying power by how much? It's roughly an 11% reduction. Just a tiny interest bump completely changes the price tier of homes you can even shop for. Last question. What crucial calculation must you do before you pull the trigger on a mortgage refinance? A break-even analysis. You absolutely have to make sure the monthly savings are actually worth those hefty upfront closing costs. Listen, as your loan advisor today, my ultimate goal is to see you safely and comfortably enjoying your new home just like this. All this math, these ratios, the interest rates, they're not here to stress you out. They're here to protect you, to ensure that your home remains a powerful engine for wealth building, not a source of anxiety. So I'll leave you with this. Grab a calculator and ask yourself honestly, are your numbers truly ready to handle the realities of today's housing market? Run your ratios, check your credit score, and do the break-even math. Because in real estate, hope is never a strategy, but mathematics absolutely is.